So welcome to part 3 of understanding the purchase and sale agreement as a buyer. Keep in mind this information is related to the mortgage process. I'm not a licensed real estate agent, so I'm not talking about how to negotiate the contract, nor am I an attorney giving you any type of legal advice. So we're going to get into today. We're going to talk about the expenses when it comes to the closing the transaction. If you like my videos, make sure to go ahead and subscribe to my channel and hit that like button. Drop me a comment. So today we're talking about the closing expense and who's responsible for what. Once again, this is a Tennessee real estate contract. They are very similar across the states, but each state has a tendency to have their own language in their contract. Also keep in mind, depending on what state you buy, the sellers may have a certain expense that they have, and the buyers a certain expense. And what I mean by that, for example, in the state of Tennessee, the buyers typically pay what's known as the transfer tax. That is the tax that's paid on transferring the property. There are other states where it's customary that the seller pays that. So a lot of times these expenses are based on what's customary in the location that you're purchasing the home. So let's talk about the seller expenses. So in the state of Tennessee, and in this particular scenario, we're looking at the seller expenses, which are typically not much. And what I mean by that is the basis of the seller expenses is traditionally the commission. That's the largest expense we commonly see that they're going to pay the agent. Outside of that, it's going to be making sure that the new owner has a clear title. So any type of expense associated to any liens on the property, if there's any taxes due, that would be responsible for being paid. Any mortgages that are out there, any judgment liens that are out there, any of those type of expenses that may put a cloud on title have to be paid before the seller can actually give clear title to the buyer. One common thing that can get overlooked sometimes is considered a UCC lien. A UCC lien is when someone goes and possibly buys some type of water heater or a heat pump or an AC unit. And a lot of times when they do that, they don't realize that the company has filed what's considered a UCC lien against the property, so therefore that comes up. So as a seller, you want to make sure to talk to your real estate agent. You want to see what a net number is, so less any liens, and then it's also a good time to talk with the title company that's going to be conducting the transaction. They're going to do a search, and they're going to let you know. Depending on when the transaction closes, the seller will give a proration of taxes over to the new owner. So if this closes at the end of June, then the seller is going to give a credit from January the 1st until June the 30th. Outside of that, the other fees associated, with the exception of what's negotiated, is going to be your typical deed fees from your title company, closing fee from the title company, which generally those are a few $100s. So on the seller side, commission is the biggest thing, clearing all the liens, clearing all the title, but as far as the true closing cost expense, it's going to be very minimal. Now, the buyer is the one who takes on the closing cost. So within a loan transaction, the buyer has to pay for the closing cost within the loan. And those closing costs are laid out. It varies just depending on lender. Lenders have processing fees, underwriting fees, some charge origination fees, but then you also have the additional expenses such as your credit report fees, your flood fees, your appraisal fees. So there's different fees. That's where your loan estimate comes into play, and it shows you exactly what these fees are, your transfer tax, your prepaids. So all of those in section D of this contract, part 2, is going to fall under the buyer's expense. What is the buyer required to pay? So in a typical transaction, a lot of times people will use a general rule of thumb of 3%. That's not an exact number. It all varies, like I said, based on location. So let's say a $400,000 home. If you factor the 3%, roughly the buyer's closing costs around $12,000. Now, that includes prepaids. So within a loan transaction, there are what's considered your closing costs, which are your hard costs as processing, underwriting fee, any lender fees. Then there are appraisal fees. There's the title fees. Those are closing costs. And then the additional part of your closing cost are your prepaid items, which is your escrow, It's your prepaid interest from the time that you close. So you can look at your closing costs being broken down into sections, your typical closing cost, and then you add your prepaids to that. So that's something you have to factor. So with the buyer's expenses, you have to make sure you've got your first year homeowner's insurance is going to be in place. That's part of the closing cost there. And then any other fees such as discount points, if you choose to pay those, that is part of your closing cost as well. As part of the closing cost, this is where the negotiation comes in between yourself as the buyer and the seller. So these are all standard closing costs paid by the buyer. However, there is an opportunity that you could have the seller to pay these costs on your behalf. So that's what we're looking at as a seller credit. So let's talk about that real quick. First of all, I want to cover the different programs and the typical thresholds they allow as far as a seller concession. Number one is going to be conventional. So with a conventional, if you put 5% down or less, the seller is going to be limited to paying 3% towards your closing cost. So they can pay that 3%. That can cover, for example, earlier the $12,000. That could cover that $12,000 in closing cost. Now, if they put more, if they put 10% or more down, then the seller can contribute more towards the closing cost than just the 3%. On your government loans, such as your FHA and your USDA, they do not have a down payment requirement that would adjust the seller credit. So for FHA and USDA, you can actually, the seller can contribute up to 6% towards your closing cost. So if you're thinking about that number on the $400,000 example we were working with, and a seller chooses to pay 6%, which is $24,000 towards your closing, keep in mind that cannot go towards your down payment. It strictly has to go towards your closing cost. So if your contract was negotiated like that, then your lender should be looking at how they can best utilize any additional above the minimum closing cost. So let's say the standard closing cost is the $12,000, but you've negotiated within a contract $24,000. So what happens with that extra $12,000? If you don't use it, it goes back to the seller, and that's not something that you would want to happen. That's not going to benefit you in the way you negotiated the contract. So typically there's a few things that the lender will do. Number one is they're going to look at a permanent buy down option. So they're going to look at an option to say, how far can we use this extra $12,000 to give a better rate to my buyer? How much will that improve their permanent buy down? So that's one option. Another option is called a temporary buy down agreement. It's where they utilize that money to reduce your rate, depending on what the term is, maybe it's for the first couple of years, by a certain percentage, and they're utilizing that excess between the $12,000 and the $24,000 to do that. So each program has that. The one misconception is the VA loan. So with the VA loan, you actually, the misconception is that the seller can only pay 4% towards the closing, and that is not accurate. The seller can pay all closing costs as long as they're customary, as long as the lender's not trying to throw anything in there that's not a non-customary. The seller can pay all of the closing costs. It does have limitations on discount points. Generally, that's upwards of 2, maybe a little over. But a lot of people get that confused with 4% because it says the seller can pay up to 4% for a VA loan seller concession. Here's the key to that. The 4% seller concession on a VA loan is actually a threshold towards things like paying off the seller's debt. So if you're looking at that and the seller on a $400,000 deal, they're paying $20,000 in closing, but only $12,000 is the actual closing cost. Within the 4% threshold above the closing cost, the seller can actually pay off the veteran's debt. A lot of times this can be negotiated to help the veteran qualify. If the veteran has a vehicle that has $8,000 on it and a $500 payment, that concession can be used as part of the closing cost to help, or I'm sorry, not part of the closing cost, but part of the concession to help the veteran pay that off to afford the home. Keep in mind though, the home has to appraise for whatever's negotiated within the purchase price of that. So that's a big key there. Now let's talk about the negotiation strategy that could help you go above those concessions if needed. Let's stick to the conventional example that only 3% can be paid towards closing cost. Within this contract, there's also its own special section that says title expenses. So if your agent writes in there that the seller is to pay title expenses, this includes the title search, the cost of the title search, the mortgagee's policy, and the owner's policy. So those items are different on your itemization. That would be above and beyond, let's say, the 3% example that I give you on the conventional. So what does that mean? That means the seller would agree to pay $12,000, which is that 3% max. But if they also agree to pay title expenses, that's above and beyond. So you as a buyer could benefit more if your contract specifically states that the seller is to pay title. It's not part of the concessions that would be negotiated. Now, how can that backfire? That can backfire if your agent comes down below and they overwrite the contract by stating something like this: seller to pay $12,000 of buyer's closing cost, including title. If they use the word title in their negotiation, then that negates the fact that the seller would pay above and beyond on the title expenses. So when we look at that, it's very important to keep in mind how you're negotiating. Depending on the area that you're purchasing, title expenses can be quite a few $1,000s. So if you as a buyer can take an opportunity to get more than just the minimum 3% contribution above that, then that in itself would help save money. So it's important at the end of the day. The other part of this is determining who is going to be the closing attorney, who's going to be the closing agent within this. A lot of the other factors that play a part in your closing expenses when you close. If you close towards the first part of the month, then do keep in mind your prepaid interest is going to be larger than if you close toward the end of the month. However, the payment is going to be based on the time that you close within the following month. And what I mean by that is if you close in June, then your first payment is not going to come to you until August. If you close June the 2nd, you're going to pay more prepaid interest, but your payment will not come due until August. So there's all types of consideration that you have to look. And very quickly on part of the other cost associated, I've shared this within some of my other content, is the earnest money. So once you sign this contract, your agent is going to ask for earnest money. That earnest money is the commitment that you are giving to the seller that you are moving forward with the contract. It's the fact that you are serious about it and that you're going to give them a deposit so you can continue the process of the loan. So you can continue with ordering the appraisal, doing all of your lender obligations of getting the file going, and that you do want to move forward in purchasing their home. Within the earnest money, there's certain stipulations on when that can be refunded. For an example, if you negotiate a home inspection and you do not like the results of the home inspection, you can deliver that information back to the seller. The seller does a release, you get to obtain your earnest money. The other portion of that reason may be if the appraisal does not appraise for what it is, another contingency within the contract, you do not have to move forward with the contract, therefore the earnest money would be refunded back to you. If there's a reason for a loan denial that is beyond your control, meaning that the lender denied you for a loan, you didn't sabotage the loan by going out and buying a new car, quitting your job, or anything like that, then financing contingency is a reason, if you cannot obtain the loan, that you would receive your earnest money back. And there's other different variables within the negotiation of the contract that you would look at. So if you have any questions in regards to the closing expense, so number one, you want to make sure you're working with a lender that's going to be very detailed up front before you ever write a contract with your proper expectations. You want to know what your estimated closing costs are. You want to know what your cash to close is. You want to know what your program is that you're approved for. All of those variables are going to play a part in your total budgeted cash to close. If you have any questions for me, please feel free. Let me know. Like I said, if you're liking the information, make sure to subscribe to my channel for more information on the mortgage process. Also, give me a like and just comment below.